Hi, and welcome to Homework Rants. Professor Elizabeth Keating is going to walk through a homework problem from the Introduction to Financial Accounting of Horngren, Sundom, Elliott, and Philbrick, the 11th edition. And the problems are the same as the ones found in the second custom edition for Boston University. Going to be looking at problem 254, and the goals and objectives is to look at the expanded financial statement template, how to prepare an income statement, what is the retained earnings statement, how to compute it. I'm going to introduce some important accounting concepts, including the periodicity concept and the matching concept. We're going to review 3 of the 4 different types of accrual accounting entries that we can have, and we'll discuss the closing process. So this is an example of the expanded financial statement template. We will complete this template over the course of the video, but one of the things I want to highlight right now is that in the expanded financial statement template, we have the balance sheet, which are the columns with the headings at the purple at the top with opening balances. We have revenues and expenses, which are the temporary accounts, which are being created in order to allow us to prepare the income statement. And once we prepare the income statement, the amounts from the revenue and expenses are carried over and posted into retained earnings, what you can see in the green in the retained earnings column. And finally, this particular video is also going to include what happens when we pay a dividend, and that dividend you can see in orange. The dividend does not appear as a revenue or an expense in those columns, but gets posted directly to retained earnings. Before diving into individual entries, I'd like to talk about these 2 concepts, periodicity and going concern. Periodicity is the idea that an entity's economic activities can be divided up into consistent or artificial time periods. So throughout accounting, we're going to arbitrarily end activity at the end of a month, at the end of a quarter, and at the end of a 1-year period. The second idea that's important to think about when we're doing accounting is called the going concern convention. That's the idea that an entity will persist indefinitely. If we make that assumption, then we can go ahead and book many activities under the assumption, for example, that customers will pay us later or will be able to pay suppliers later. If a firm is in bankruptcy, there'll be some changes in that assumption and the accounting might be slightly different, but that's well beyond the scope of this course and video. So what we're going to see, we're going to kick off working through an example of a firm that's in business. What we can see across the top in purple are the opening balance sheet values associated with the balance sheet accounts that will be true for this example. And across the bottom, we can see the resulting closing balances. What's going to be posted in that middle section are a set of transactions. We'll dig into those transactions right now. Let's look at our first transaction. What it says in 254 as our first transaction A is that the firm is purchasing inventory on credit and they're buying $1 million worth in credit. What we're going to do with the financial statement template is we're going to be recording amounts in thousands. So what that means is $1 million will be reflected in the financial statement template as 1,000. So you can see here inventory is going up by 1,000 and that accounts payable is going up by 1,000. So let me review a little bit about these accounts. Inventory are goods and materials that we purchase specifically with the goal to resell these items at a profit. An account payable is a type of liability, and that's where we're going to store and record some of the business IOUs. In the case of an account payable, it generally is debts that we have that are business related that are documented with an invoice. And so in this particular case, we're not paying for the inventory right off, we're agreeing to pay later. So we're going to record as an offset to that 1,000 in inventory, we're going to record an increase in an account payable. And we're originating here an accrual, a type of account, an account payable. That's why the pink star is there. And at some point in the future, we will be paying off the supplier and this account balance will drop. Now to our second transaction, we're going to sell some goods to some customers on credit. So now the customers will be paying us in the future. In fact, what the problem says is we sell $1.7 million worth of merchandise. Customers pay us $200,000, and the remainder, the $1.5 million, will be paid to us later. So we can see cash going up by $200,000, accounts receivable going up by $1,500, and together that equals the $1.7 million we see being recorded in revenues. And so we can see that little tan arrow being displayed between revenues and retained earnings. And that's to indicate originally the journal entry will record that 1.7 in revenues, and as part of the closing process we will end up closing out that revenue account and transferring that balance into retained earnings, which is the permanent account. So we can see that this is an example of the realization concept, which is a revenue will be recognized once a good or service is delivered and rendered, but not before that. I do want to talk about the pink star above the account receivable. That's to indicate that that particular account is an accrual account. It is arising because there is a timing difference between when there is a cash movement and the realization of a revenue. In this particular case, the revenue recognition is happening now. The cash movement will be coming later. So we are originating an account receivable, and later when we are paid, the account receivable balance will drop or reverse. Now, we did recognize the revenue in that transaction, but we haven't yet recognized the fact that we removed from inventory the goods that we sold. And so that's what we're going to do with journal entry C. So inventory will drop by $1.3 million, and the cost of that inventory will now be reflected on the income statement under cost of goods sold, which is a type of expense. So the fact that we're recording this entry right now, essentially together with journal entry B, is what's called the matching principle. Expenses will arrive on the income statement, be recorded and reflected there in the same period as the associated revenue. We're now going to take a look at what is going on with the prepaid rent in this example, which is requirement D, and I'm going to break it up into three pieces. The first part is we can see on the initial balance sheet that starts, there's $45,000 in prepaid rent. That prepaid rent covers the rent for the firm from January through September. So in other words, the rent is at a pace of $5,000 a month. So we're here at the end of the month and at the end of the year, and we're trying to figure out how much in total rent expense should be recognized, should be included on the income statement. So the first part that should be on the income statement is the rent associated with the first 9 months, which is this $45,000. So the journal entry we're going to record is a decrease to the prepaid rent to remove all of it from the balance sheet and decrease or a reporting of that $45,000 as an expense on the income statement, reducing retained earnings. So we're taking an existing accrual amount on the balance sheet and reversing or removing it. So the second part of requirement D is that we're going to reflect the fact that we entered into a brand new contract to use space for $84,000. So we paid out $84,000 in cash, and we got back in exchange a promise to allow us to use the space for the next 12 months. So we're going to take that benefit of $84,000 and record it as an asset in the balance sheet in the prepaid rent category. So now what we're doing is we're creating an originating entry. We're capitalizing the $84,000. Capitalize means to store on the balance sheet. And the reason we're going to do this is because we're paying the cash today, but we're not going to get the benefit of that cash until some point in the future. So now we're going to look at the last part of Requirement D. So if you remember, in the first part of Requirement D, we recognized $45,000 of rent expense, recording it on the income statement, and that covered rent from January to September. Now we need to include the rent for October through December. So if we look at that $84,000 in cash that we paid and ask ourselves, that's for a 12-month period, how much rent it is then per month, it's $7,000 a month. So now what we're going to do with D3 journal entry is we're going to recognize 3 months of rent at $7,000 or $21,000. So you can see $21,000 being included in the expense column and $21,000 being removed from the prepaid rent balance on the asset part of the balance sheet. Now, having recorded the rent for the period, we're going to now look at other activities that need to be included as expenses in the income statement that are accrual in nature. In other words, non-cash in nature. And one of the things we're going to recognize is that we have some equipment and we've used it, and hence it's declined in value. And so we're going to need to depreciate that fixed asset. And so it tells us in the book that's $20,000 worth of value. So we're going to record depreciation expense of $20,000 over on the right, and we're going to reduce the equipment balance by $20,000. So we're going to be expensing an asset, reversing away the amount that's recorded in the asset column on the balance sheet. Well, it turns out here we are at the end of the month, and some customers are now paying off the obligations to us. So in Journal Entry B, we had added to accounts receivable to the tune of $1.5 million, and we now recognize that some of those customers have paid us, so we received $1.25 million in cash. So cash will go up by that amount, and the amount that's shown on our balance sheet as owed to us will decline by $1,250,000. One thing to note, this journal entry is there's no effect on revenues. We are collecting amounts owed to us from previous activity. At the time we recorded the previous activity, we recognized the revenue. We're now going to look at Requirement G and Requirement H together. Both of these requirements discuss expenses the company has incurred and is paying for in the current period. So we're going to reflect for Requirement G an outflow of $200,000 in cash and an expense of $200,000, and for Requirement H an outflow of $70,000 in cash and a reflection of $70,000 in expenses. These are examples of concurrent transactions. There's no accrual accounting involved. The cash and the economic activity both occurred in the same time period. Now in Requirement I, we're going to look, and the firm is now paying some outstanding bills. So they're going to pay out $900,000, and the amount of their outstanding bills, the accounts payable, will drop by $900,000. So this is a kind of reversing entry. We're reducing the accounts payable when we do this. Now, something to note here, if you look over in the expense section, no expenses are being recorded. Why is this? We reflected the expense associated with this activity already in other transactions. All we're doing is reflecting right now that we're taking cash and paying down an outstanding debt. In Requirement J, we're looking at how we did. We did pretty well for the year, and we've decided to declare and pay dividends to investors. So we're going to pay out $100,000 in cash, and when we pay out a dividend, that's reduces the equity, reduces the amount of the investor's contribution to the business. So retained earnings will drop by $100,000. And again, as noted earlier in this video, that $100,000 is being taken directly out of retained earnings. It does not first appear on the income statement. Okay, so we've now recorded all the activities in the middle, and we can go about computing the closing balances. So what we're going to do to compute those light blue numbers across the bottom is we're going to start with the number in the purple box, the opening balance, and then we're going to add straight down the column. Any positive numbers viewed as an increase and will be added, and any red numbers viewed as a decrease and will be subtracted. So we're now going to take a closer look into what's happening with the income statement activity. Up until now, the transactions that we've recorded have been recorded into the revenue and expense accounts, which are temporary accounts on the income statement. We're now going to engage in a process whereby we compute how much net income is and what is the effect of our business activity in this period on retained earnings. So we'll start by recording the name of the firm. It's the Gecko Toy Company. The name of the statement, the income statement. We'll now talk about the time period. An income statement is a flow statement covering a time period. So we'll tell the time period, which is a year. So for the year ended December 31st, 20X1. We're now going to look at the revenues and the associated cost of goods sold. So we had sales of $1.7 million and associated inventory product costs of $1.3 million, which we'll report as cost of goods sold. And then to help out the reader, we're going to compute a subtotal to say what the profit is just on that small calculation. So we will have determined that the gross profit for the period is $400,000. Next, we'll look at the remaining expenses and determine which of those are operating expenses. So when we go and look, we'll determine that the rent for the year was $66,000, which is the $45,000 for the first 9 months and the $21,000 for the last 3 months. We have depreciation of $20,000. We have wages, which is one of those two current expenses that we paid, of $200,000, and we have miscellaneous expenses of $70,000. When we add those operating expenses together, we will have total operating expenses of $356,000. We'll now compute net income as we've already reported all the individual revenue and expenses. So the net income will be the gross profit minus the total operating expenses, and that will give us $44,000. So due to our business activity this year, we've earned $44,000. Now it's time to update our retained earnings. So what we're going to do is we're going to prepare a statement of stockholders' equity. Actually, we're just going to prepare a statement looking at what's happening to retained earnings. So again, we need to start with the name of the company and the name of the schedule and the time period involved. So again, it's for the year ended December 31st, 20X1. We'll start this calculation by looking at the opening balance, which we started with retained earnings of $645,000, which were reflected on the balance sheet that was provided. We will then add in the net income we earned for the year of $44,000 and subtract out the cash dividends declared of $100,000. So now we can compute the final retained earning balance of $589, and you can see we can then use that to update the retained earnings balance at the bottom of the financial statement template. Okay, so let's introduce a different way that we could go about updating the retained earnings balance. So what you can see at the bottom are two T accounts, one for revenues and one for expenses. The revenues is going to have as a normal balance a credit balance, and the expenses will have as a normal balance a debit balance. If what you did is you added up all the revenue accounts and subtracted all the expense accounts, you would come up with the net income number, which, if revenues are exceeding expenses, would be a positive number with a credit balance. So what you could do is close the revenue and expense accounts and transfer those amounts into the retained earnings account as net income, as a credit. And then what you could do is you could record the dividends on the debit side, and then you would have an updated retained earnings account. So let me show you how that works. So you'll see our retained earnings account, and that we have posted $645,000 as an opening balance on the credit side. We're now going to record the net income also on the credit side of retained earnings. And now we're going to record the cash dividend of $100 as a debit, as a decrease in retained earnings. And then we'll compute where we are. We'll add the 645 to the 44, and then we'll deduct the 100 in cash dividends, and so we'll compute that our ending balance is $589,000. And that concludes what I'm going to go over for homework problem 2-54.